So, in this video, I'm going to explain a little bit more now in August. We are on the 3rd of August. Explain a little bit more how I got these numbers and what the market seems to be pricing. So, here's the spreadsheet that I used. It's slightly different from the one that I used here because here I have the earnings previous, predict, and growth more explicitly stated. So price is the most recent top of the S&P 500. Earnings, these are the previous year's earnings that I got. They are publicly available, 205.19 dollars. This is what one could say is likely to happen for 2022, which is a reduction in growth in 10% in terms of earnings. So a reduction in 10% in terms of earnings. So earnings growth of minus 10% for the year. That would give us predicted earnings of 184.67 for 2022. The PE based on this number in previous earnings is 26.09. The 10-year Treasury rate uh, is 3.5%, which is what the Fed is currently indicating you would have to be by the end of the year. Um, Fair PE is calculated as this 10-year rate, or 1 divided by the 10-year rate, which the 10-year rate is the earnings um, per share for that particular instrument, which is a fixed term instrument, is a bond, divided by 2. This is a conservative view of the fair PE that tends to be adopted by value investors. But when you are in a market where a bear market where you have a fall from a top, so the market is going down and with rallies, typically the market becomes a little bit more conservative. So this fair PE is a reasonable estimate based on this rate. Now, as the rate goes down, the fair PE tends to go up, right? So if rates were to be, say, 2%, then you would say that the fair P is close to the current P. But I'll keep that 3.5% here for discussion purposes. So, given this drop in earnings for 2022 compared to 2021, we would be looking at a fair price considering this 10-year rate of 2,638. So that would be a drop from the top in the S&P 500 of close to 45%. Now, let's see what we have currently uh, as the 10-year Treasury rate. So this is from CNBC. The current 10-year Treasury is, in fact, 2.73. So if I put this number here, 2.73, then our fair price for the S&P 500 is 3,382, considering this drop in earnings of 10%. Now let's take a look at what the market is currently pricing the S&P 500. So the market is currently pricing the S&P 500 at 4,159.45. So let us go to forecast, what if analysis, goal seek, and then let's set the cell with the fair price to a value of what is there, 4160.40. That's what the price, that's what the market is pricing the S&P 500 right now, by changing the earnings growth. So the market is currently pricing the S&P 500 based on the expectation of earnings growth of 10%. In other words, the market expects earnings to grow 10% this year at the moment. The market, that is the S&P 500, in this case, tends to be very efficient at pricing things, pricing itself, or pricing the S&P 500 based on all of the information available. Tends to be much more efficient than a single individual. Um, so, what could change this scenario would be an increase in a 10-year rate, more in line with what the Fed is indicating, which is 3.5%. Which, by the way, if you check the 2-year Treasury, this tends to predict what the Fed funds rate will be in the near future. So it's at 3.09%. So let's assume that it's not 3.5, which is what the Fed is saying. It's going to be 3.09. Keep in mind that inflation is around 9% right now. So you would expect the Fed funds rate to be much higher than what the 2-year rate indicates. But let's say we get to that number, then still we have a fair price for the S&P 500 uh, to be, uh, this assumes that the 10-year rate will be at this level, which is not what the market is pricing. In fact, what we have here is an inversion. The fact that the 10-year Treasury is lower than the 2-year indicates that the market expects the Fed to reduce interest rates in the near future because of a recession. If there is no recession, then the market would be expecting the 10-year rate to be higher than the 2-year Treasury rate. So, what the market currently is predicting is a recession, which is inconsistent with this 10% earnings growth for the year. It's rare for you to see earnings growth, even nominal earnings growth, if we are in a recession. So it looks uh, that the valuation of the S&P 500 right now is correct based on earnings figures that we're getting at the moment. So what looks like it will be happening based on what the bond market is telling us with these 10-year rates, 2 years rates, and so on from a data analysis perspective, from a data analytics perspective. What seems to be happening is that the bond market is pricing in a recession, but currently earnings are not in line with what we see as a recession, which could end up meaning that earnings will deteriorate in the next quarter or fall or at the end of this first quarter, which seems consistent with the guidance that we've been getting from companies that there will be a deterioration in earnings going forward in the third quarter and then fourth quarter perhaps. But even with an expectation of 10% growth and with a 10-year rate of 3%, which is what the Fed funds rate would be. So if the Fed funds rate, it looks like it would be around 3.09% by the end of 2022. Um, then we would expect, even with a 10% earnings growth, a fair price for the S&P 500 of 3,675. So that would be a 20% drop from the recent top. So it really, the way this is looking right now from a data analysis perspective, suggests that there is more downside going forward for the S&P 500. And this, of course, this does not even consider um, geopolitical issues such as the war in Ukraine, possible conflict with China, and the impacts that these could have in the earnings, in the growth in earnings for 2022. So this concludes this video, which is provides more color on how these estimates were generated um, for this uh, post on on the Warp Investor blog on July 20, 2022. Thanks for watching.